Why a tax audit? What is the difference between a financial audit, a forensic audit, and a tax audit? Most companies are in trouble because they did audits, financial audits. They did, they brought auditors on board who don't know what to do. And right now they are in trouble in taxation. Why should you be at KRA, at URA, at TRA, RRA, because of tax and you have auditors? So I think the best thing is, if you have tax issues and you've been having auditors for the last 10 years, they should be dismissed, because you have no problem because you didn't know or you don't know, but the auditors ought to have advised you better not to be in such a position. I am Tony Musisi from Trustway, and we want to be discussing with you free knowledge about taxation, free knowledge about audit, free knowledge about systems. For the last 15 years plus, we've been automating businesses. We've automated about over 5,000 businesses, sorted complicated taxation cases, out of which include refunds, objections, appeals, negotiations, and cleaning. So that's our expertise. So we come to you with the knowledge base to help you run your business better, to help you run your businesses better. And that's, I think, what all our professionals should be doing. Why do you need a tax audit? Why do you need a tax audit? Most of the challenges people face is they file their incomes the way they are in their systems. Of course, which is good and which is very important, but we've realized over a number of times and over a number of cases, when you file your incomes, and I think let's first talk about the revenue, because a taxman, what is a taxman interested in? A taxman is interested in collecting revenue. What is a businessman interested in? A businessman is interested in collecting revenue. So both the taxman and the salesman, all of them, their urge and their ambition is to have revenue, is to have a fat bank account. And you see, this is also the mistake most of our businessmen do, is they keep on sending money on accounts that are not even revenue, but these amounts are not even documented. And what are they trying to achieve? Probably at the end of the year, they want to produce this fat bank account, maybe to the embassy for them to fly out, or to a bank so that they can receive more money from financial institutions. Because also financial institutions are looking at your cash flows and your inflows. And as they look at your cash flows and as they look at your inflows, they think you're earning. Money comes in, money goes out. But this is what business people do. They get one account, another account, they get money and keep on switching monies from one account to another account, just to confuse the banks and to confuse the embassy. So, and this is what they do on revenue, and it's very, very dangerous when it comes to the taxman. When it comes to the bank, yes, you might survive people dropping money on your account, and after you give it back to them, you choose to incur the bank charges as your expense so that you can have a fat bank account. But this is the challenge, that the challenge here is some of these transactions do not have documentation. We especially in the African setting, we lack the culture to document our transactions. We lack the culture. We even have accounting systems. We even have accounting softwares. And these approvals are done on WhatsApp, no email. WhatsApp, you know WhatsApp, in a month or 3 months it cleans itself, and then you don't have any backup. So here you are on a taxman that has been given a target of 2 trillion per month, or 10 trillion per month. And then you keep on explaining, you see this came from here, you see this was a loan, you see this was a deposit, and then they're asking for evidence and you don't have it. This is how people have gone into objection, have gone into tax tribunals, have gone into dispute resolutions, have gone into court. And they lose out. And they lose out. And they are rejected. And then a business person ends up paying money, ends up paying an assessment, administrative assessment, because of under declaration that they did not actually make the money. So, and the taxman doesn't want to know. It's a loss, it's painful. And then you end up abusing them, but they are also doing their job. They are doing their work. It's you who did not do your work diligently, properly, with knowledge. And you can, by the way, eat your money and be happy with your tax authority and enjoy business. But you see, most business people throw away tax consultants. They only run to tax consultants when they have a problem, when there is an issue. Without an issue, without a problem, they don't need tax. They run their things. When they're in trouble is when they call. And then these tax authorities ask a lot of money, and ask them, okay, if you want me to solve your problem, give me two. What is the case? The case is 1 billion shillings. Wow. Okay, for us to help you, 40% of the tax, and we shall save you, and you pay out of the 1 billion, you will pay 150. By 40% of 1 billion is 400 million. Literally, you have paid 500 million to be free from, even if they said 30%. Most of them ask for 30%. So 300 million plus the 150 which you're going to pay to show you're compliant is actually 450 out of 1 billion. And then they go in IT and talk to them, and then they change those transactions and stuff. And then before you know it, after 2, 3, 5 years, the case is back. And the other person switches off the phone. All if the person is so understanding and sharp and bright, you realize they will go into reconciliation and realize out of the 1 billion, you have interest of 600 million. So you have actually paid 150, and then they only deal with the principal of 300 million. And you realize if you had a very good tax planning or tax consultant or auditor, you wouldn't have been in that mess, or you'd clean for good. So most businesses are closing up because of you. Uganda Revenue Authority, Kenya Revenue Authority, Tanzania Revenue Authority, Rwanda Revenue Authority. I'm saying this because the tax system across East Africa is the same, but also globally, they are the same principles. They are the same. So, going back to revenue, so we say you have these bank statements, they are here, and then there's these tax people, tax agents, so officers are very wise. They say, okay, bring your bank statements. So, you put your bank statements, and then they realize that you have more credits on the bank statement than the income tax revenue declared. If the income tax is lower than the bank statement credit, and they will ask for the evidence of loans and how you utilized them. And whatever cannot be evidenced on the bank statement is going to be added back to the revenue that you declared in income tax. But also they don't stop there. Amazingly, immediately after that, they are going to go to what we call the VAT returns. So they'll go to your VAT returns, and guess what? Start to compare now your monthly returns, cumulative for the year, vis-a-vis the revenue. So you're going to have issues now whatsoever if they do not tally, if they are not matching. You are in trouble, good trouble whatsoever. And that comes with penalties, that comes with interest, that comes with fines, and the income thereof. Plus the VAT on it. So if the difference is 500 million, get 30% of 500 million. That's some good money. That's about 150 million. Plus the interest and the penalties. So you're in 250 million. Ooh, plus the VAT, 500 plus 18%, you have about 80 million. Wow. So 88 million in VAT, 150 million in income tax, and so you have not less than 300 million in tax simply because of the omissions either by accountants or oversights by auditors. And then you cry. So you painfully pay the 300 million, which would have been your profit. And our fellow Ugandans and East Africans, there is a niche that I want you to be aware, but I know also the governments are working on it. The systems are not ionized or automated to auto-calculate automatically IFRS. Kenya, we call it e-teams. I think also Tanzania, is it e-teams? I also think e-teams. Uganda, they call it IFRS. Invoicing, online invoicing through the URA portal. Now, there is still a problem that these systems cannot auto-reconcile with the portal on VAT. They are trying but not their best. But until a stage is coming where whatever you sell will automatically be the return which you've made and will automatically be the income which you have done. If that was possible, we wouldn't have been in trouble. But I think also they are making it intentionally not to reconcile, because under an open system or a right system, that's what it should have been. But I know they are intentionally not doing that because they are also hiding behind that loophole to catch mistakes. These regulatory authorities are not here to guide us. They are waiting for mistakes from us to penalize us, which I think is wrong, but they are also collecting as much money. If you knew these things, they would not make money. Most of the monies are being made in administrative assessments, additional assessments. And they will wait for you for 5 years, for 3 years. So, bribing a tax officer will not solve your problems. Doing a tax audit before they audit you is the best solution. Please contact us on if you need more guidance, if you need more solutions, contact us on the numbers below or on our website. We shall be able to help you and guide you more for consultancy, for tax issues, for audit issues, for systems issues. I'm Tony MC from Trustway. God bless you. See you. If you are being blessed by this video, share it with somebody. It will save them a lot of money. This is knowledge bought, given out freely. Why can't you also give it to someone free of charge? Thank you. See you again in our next podcast. Bye-bye.